Do you want to know where your money actually goes when you buy a home instead of renting? Understanding the difference can save you thousands of dollars and help you make the smartest financial decision for your future. Today, I'll break down different mortgage payments and show you how much goes to paying off your home and how much goes to interest. I'll also explain what interest actually is and how big of a deal it is for your wallet. But first, if you want to learn exactly how buying and renting works, as well as different strategies you can explore to make your financial decision easier and more beneficial, then please subscribe to this channel and leave questions in the comments so I can continue making videos and help you along with your housing journey. In this video, I'll explain what makes up your mortgage payment. I'll teach you what principal and interest are and how they work. I'll show you what your payments do over time with something called amortization. And I'll compare different interest rates and see how they affect your payment. First, let's break down what makes up your mortgage payment. First up is principal. This is the amount you borrowed when you bought your home. When you make a payment, part of that goes towards paying down that loan amount. Interest. This is the cost of borrowing the money. It's what the bank charges you for lending you the funds to buy your home in the first place. Interest is calculated as a percentage of the loan balance. Taxes. These are the property taxes you need to pay on the assessed value of your home. Most of the time, these taxes are collected by your lender and they're paid on your behalf to make sure that they're paid on time. Homeowners insurance protects that investment you've made in your home in case there's damage to things like fires, storms, or theft. Just like taxes, this is often collected by your lender and paid to the insurance company for you. While taxes and insurance are important parts of your mortgage, not every single mortgage will include these things. It may be your choice whether or not you pay them on your own or you have it as part of your mortgage payment. So today we're just going to focus on principal and interest only. And these are two components that really make up where most of your money goes. Now, knowing how these work can help you manage your payments better and potentially save you money over time. So let's dive deeper into what principal and interest are. Let's start with principal. This is the original amount that you borrowed to buy your home. For example, if you take out a mortgage for $300,000, then that $300,000 is your principal. Over time, as you make your monthly payments, you slowly pay this amount down. But next we have interest. Interest is the cost of borrowing that money. It's what the bank charges you for lending you the funds to buy your home. Interest is calculated as a percentage of the remaining loan balance. So in the beginning, since your loan balance is higher, you're going to pay more money in interest. And as you pay down the principal over the years, the amount of interest you pay each month decreases. So when you first agree to take that loan, you will agree to the term, which is the length of time that you've agreed to borrow that money and pay it back for. So that term will be a set number of years to pay off the entire loan. In some cases, you might have a certain kind of loan that the term you agreed upon is just a length of time until something changes about your loan, not necessarily the length of time it's going to take you to pay it off. But for now, let's just keep it easy and talk about mortgages that you pay off after that term. So here is an example. Let's just say you have a $300,000 mortgage with a 30-year term, and we have it at a 5% interest rate. Okay, so we're going to split these monthly payments up for 30 years. And that cost to you is going to be that 5% plus the amount that you have to pay each month to decrease your principal. So here's what it's going to look like when you pay your bill each month. Your monthly mortgage on this would be $1,610. Now let's see how the payment is divided between principal and interest during that first month. For your principal, a small part of your payment goes towards reducing the loan amount. And in the first month, this might be about $360. Now, a larger part of that payment goes towards paying your interest. And for the first month, it could be as much as about $1,250, which equals your $360 towards principal, $1,250 towards your interest is going to be that $1,610 payment. So in the beginning, most of your payment goes towards interest, and only a small portion reduces that principal. And this shift in how much you pay toward your principal versus your interest over time is called amortization. Early on, you're going to pay more interest to your loan because your loan balance is higher. As you pay down the principal, the interest portion of your payment decreases, and more of your payment goes towards reducing that principal. So by the end of the loan term, most of your payment goes towards that principal. Now let's look at an amortization schedule. And this is a table that shows how much of each mortgage payment goes towards principal and interest over the life of your entire loan. And it's going to break down each monthly payment, showing you exactly how much is applied to each of those principal and interest columns. So to make this easier to understand, let's look at one of our previous examples. In this example, our first monthly payment is going to be in July of 2024. So if we take a look, that's about that $360 towards our principal and $1,250 towards that interest. And as you see, during that first year, not much changes between the first and the second column. You see, so much of that money is going towards the interest because that interest is charged on the entire amount of your loan. So for the most part, that $360 a month doesn't do a lot to the $300,000 loan balance you have. But if we take a look at the next year, that 360 by the end of the year turns into 386. Not a whole ton. Let's just skip ahead. Let's see what it looks like in 15 years. So we're going to look ahead at July of 2039. And you can take a look and see that now, instead of 360, it's 760 every single month. Now, 15 years into it, how much have you actually paid off? 202,000. So you're basically paid off almost $100,000 in 15 years. So if you look at it halfway through that loan, you've only paid off 1/3, or otherwise halfway through is 50% and you've only paid off 30% of your loan. Okay, so now 15 years later, the last year of your loan, take a look at the big difference. So the first year you were paying 360 towards your principal. 15 years later, you were paying $743. But then now 15 years later, it's already at $1,570. So each month, your interest that you're paying is only $39. So you can see at that last year, your principal that you're paying down is $1,500 a month. And the interest is only $40 a month. And you only have about $8,000 left. So those first 15 years look way worse than the last 15 years. And what you can see is as that big balance that you have is charged interest, you're paying so much more money to the bank. There's different strategies you can use to shorten the amount of time that you're going to pay that loan or significantly decrease the amount you're paying the bank over the years. And there's also different ways to look at it. Some people will like this if they can get a lower interest rate. For example, you're probably not going to pay the same interest rate over the entire 30 years. If interest rates go down lower than what you have today, there's a potential you could refinance or essentially redo your loan for the lower interest rate. And if that happens, you might end up having a significantly lower payment. Now, understanding how much money goes towards your principal and interest is super important because over the years, it's going to show how your equity in your home increases over time. The longer you own the home and make payments, the more of each of those payments goes towards paying down that principal. And depending on the value of your home, you're essentially gaining equity and building your ownership stake in the property. And now we'll compare a 5% interest rate with a 7% interest rate to see the difference. So using our example of a $300,000 mortgage with a 30-year term, we're going to calculate those payments again for the 5% interest rate, which is $1,610 per month. But at a 7% interest rate, your monthly payment jumps up to $1,996. Now that's a difference of $386 more each month. Over the life of the loan with the 5% interest rate, you're paying $229,767. Now with the 7% interest rate, you're going to pay $418,527. That's a huge difference. You're paying almost $139,000 more dollars in interest with the 7% compared to the 5%. And the total amount that you're going to pay for the 5% loan over 30 years is $579,767. And the total amount you're going to pay for the 7% interest rate is going to be $718,527. Now let's look at the extra payment method. And there's different ways to do it. One of them is just making one extra yearly payment on your mortgage. And the other one, which is probably going to save you a little bit more money in interest, is doing the biweekly payment. And what that is splitting each of your monthly payments up in half and doing it every 2 weeks. And what that equals is 13 payments per year instead of the 12 payments. A $300,000 house at 5% interest rate was every single month $1,610. Now over your 30 years, you were going to pay that The total interest was $279,767. So that means over the course of 30 years, your $300,000 house actually cost you $579,767. Let's take a look at the extra payment method, adding one extra mortgage payment each year. In total interest, you ended up paying $229,760, or that $300,000 house was $529,760. And the difference is you saved about $50,000 in interest and paid your mortgage off about 5 years early. Now, these numbers are pretty straightforward. They don't talk about different strategies you can use to reduce the overall amount you pay. It doesn't take into consideration rates going down and doing something called a refinance, which many people do. If you want to learn more about the strategies that you can use, then like this video and subscribe to this channel, because not only am I going to teach you all about buying versus renting and the personal finance journey to get there, but I will make it easy to follow and will answer all your questions.